Hi everyone, it's Paul Sankey here on a miserable day in Brooklyn Heights. For many years I worked, you really can't see it, it's the fog. I worked on Wall Street at Deutsche Bank, which was right there. And in fact, the level of the fog is now just about exactly at the 16th floor, which is where I had my office. I always joke there is an extra playing me in The Big Short, the movie which is set at Deutsche Bank on Wall Street and set at a time when I was working there. I used to be on the morning call with Greg Lippman, who was played by Ryan Gosling in the movie. It was crazy times. Anyway, it's 2024 now, and we're in a very interesting position as we really wait until January the 20th and the inauguration of Donald Trump. In the meantime, he's setting quite a lot of policy which involves oil and energy in a big way, but also in a very confusing way, because as I was writing yesterday, there's just a tremendous number of internal inconsistencies in Donald Trump's various policy agendas. An obvious example would be his Treasury Secretary wanting to reduce the deficit by half effectively, but also increase economic growth. It's very difficult to do those two things simultaneously. You get one or the other, basically. You reduce the deficit and you're going to slow the economy. Another one would be growing the economy whilst repatriating 10 million illegals, as they say. Again, it wouldn't be obviously strong in the short term. Neither of these things in the short term. You cut the deficit, it's good for the economy in the long term. But in the short term, that would also have its effects. And of course, the idea of cutting inflation is all very well and good in all that context, but he's also in a very big way talking about tariffs, which of course would be highly inflationary. In oil, as you know, he wants lower oil prices, but drill baby drill. Again, it doesn't hang together. And of course you have a pro-Israel and a pro-Saudi stance, which again is a natural internal tension, and it's just not clear which ones of these various contradictory policy aims will actually prevail. And we think we'll be in a pinball market such as we are today, where Donald makes a statement, in this case about healthcare middlemen, and the next thing you know, United Healthcare stock is down 4%. That's just today's action. Also interesting, by the way, to note that Nvidia is in correction territory, which is kind of a big moment in terms of the potential rollover of that stock, because essentially we're looking for the market to go lower if you want the oils to outperform. It's that rough amongst the oils. Coming back to another Trump policy agenda, which is lower prices, but also drill baby drill, which just doesn't make sense. You can't have lower oil prices and more drilling. It's very difficult to get the companies to drill more right now, let alone with lower oil prices. We had interesting stuff from the last time I sent you a video. I just come out of dinner with Chevron's CEO, and last week I was in Houston at the Exxon analyst meeting. And there was a very sharp contrast between the two, as I highlighted in the previous video, which is that at the dinner, Chevron had shortly before released a press release which had said that they were cutting capex for 25 and going to plateau levels of production in the Permian, which is an important moment because the key imbalance in the global oil market, which has been vital to maintain the oil market, we needed all the US barrels, but they've ultimately supplied too much, or there is too much oil right now. And the theory is that the most price elastic part of the oil balance would be US unconventional supply, and we're looking for a price that will get that to correct lower in order to tighten the market. The problem is the price we're at right now is not really turning US production growth negative, although of course Chevron moving to a plateau in the Permian is an important moment. However, at the same time, let's spare a thought here for poor Athena, who's being super patient. You okay, Athena? She's miserable in the rain. At the same time, Exxon did quite the opposite last week, because of course they ramped their capex. Going into the meeting, we had said that we thought the over-under on Exxon capex would be 30 billion, and they came in at 28 to 33 billion. So they kind of went over midpoint by $1 billion on our over-under, at the same time as growing their volumes aggressively, and that's what they are going to do. Of course, a lot of it's driven by their acquisition of Pioneer, but that doesn't change the fact that with Guyana, they're going to go to 5.4 million barrels a day of production by 2030, barrels of oil equivalent production, but most of the growth being in oil. That's from a level of about 4 million barrels a day today. So 20% or whatever that is more oil from Exxon, more oil and gas from Exxon over the next 5 or 6 years tells you that the US isn't going to go negative if Exxon's got anything to do with it. And again, the fact that oil is holding up quite nicely here because it's in equilibrium, the balance of oil is in equilibrium thanks to Saudi cutbacks and OPEC cutbacks, otherwise we'd be oversupplied. We're in equilibrium here with some winter, although I have to say, whilst it's a miserable day, it's not that cold here in New York right now. But you don't necessarily expect it to get that cold yet. I mean, mid-December, the key is going to be January or February for how tight we come out of winter. And in Europe, the market's tightening well on the natural gas side, which should eventually follow through to distillate and heating oil markets. And there is some life in Asian refining margins. So things are looking a little bit better at the margin in oil, especially with the weather that we've had, particularly in Europe. And that's cheered everyone up somewhat. But the Exxon higher capex, a lot more volume story has definitely tempered the way people look at the market. Not that Exxon was a surprise, but it's just a reminder that there's huge increases, and Exxon really forced this point during their presentations. They have not only major increases in productivity, but also potential future major increases in productivity. And furthermore, Exxon are very confident that they can grow the Permian beyond 2030. They make that point repeatedly, and that they have more growth potential beyond 2030 in Guyana, which is very positive for Exxon stock. It's just not great for trying to rationalize the balance to the benefit of OPEC regaining market share and market control. One of the interesting Trump internal inconsistencies I mentioned is pro-Israel and pro-Saudi. Saudi have now become very vocal about needing a two-state solution for Israel, Palestine, and are pretty negative about Mr. Netanyahu, it has to be said. So they have some demands regarding Israel. But of course, you can see with someone like Mike Huckabee going into the Israeli ambassador that there's also a very pro-Israel agenda on the part of the Trump administration. So that's a very natural tension. One tension that could work its way out, which will be helpful to the oil market, will be Trump's stated aim of shutting down Iran oil exports, which basically go to China. And that would be obviously taking out as much as 1.2 million barrels a day of oil if that was to go ahead. And by all accounts, it's in many ways already being done through tighter regulation of the shadow fleet, or at least tighter sanctions against the shadow fleet that does a lot of the smuggling. So that's also helping to tighten the market somewhat here, that you are beginning to crack down on some of the illegal oil, or illegal in the mind of US oil, that's being shipped around the place. But the big trade there is unquestionably Iran to China. And of course that Iran to China trade very much eats Saudi's lunch, right? So that historically has been a key Saudi outlet. Obviously over the last 20 years, China has been the single biggest dynamic in global oil demand growth, and much of that demand growth was met through Saudi supplying a base load of Saudi oil to China. And with the market under pressure, a big part of the pressure at the margin has been Iran. So taking Iran out could give Saudi a lot more market share, but it won't necessarily spike oil prices in the way that Donald Trump would not want it to, basically because we expect Saudi to make up the slack and go to a higher level of output. You really want to watch Iran here, actually, because the supreme leader, who is really absolutely in charge of everything, is by all accounts a sick 85-year-old Khamenei. And it's just got to watch the transition of power there. The best guess is the favorite to be his replacement is his son. And I don't think the people of Iran are too happy in general. So with Iran so weakened by what's happened in the Middle East over the past 16, 18 months, especially as regards the destruction more or less of their proxy forces such as Hezbollah, there's a lot of pressure on Iran here, as there is with Russia, and both those things could be bullish for oil. On Russia particularly, we think they're also approaching the end game, because if you look at the collapse of Syria, what you've seen there is a serious loss of Russian power that's definitely related to their struggles in Ukraine. So there are dramatic things out there, and there's going to be even more dramatic things when Trump comes to power. The one question, if you want to be long oil relative to the market, really is about whether Trump will be bad for the market, and that's not obviously the market's natural first thought, because the pro-business sort of market as a popularity indicator for Donald, which means he'll probably work to keep it going up, is a very hard one to second guess. But there's so many things out here that are basically inflationary. Most people agree that all roads here lead to inflation. That it's hard to see how some of these valuations with the market at over 30 times earnings can be sustained. So it's going to be an interesting ride once the Don comes to power. Exxon in general is doing really very well, and the company technically, organizationally, everything else is in exceptional shape. But at the moment, with weak refining, we're not sure how much we really love the oils with too much oil out there, apart from on a relative basis where we think that they're not going to go a whole lot lower. Okay, have a great... And by the way, I should mention that the AI theme just keeps coming and coming. So we remain long AI themes, absolutely. We think the capex relating to that whole theme is going to continue for several years to come. And that means bullish natural gas, bullish gas plays, bullish turbine companies, bullish anything to do with natural gas power to AI. All right, have a great day.